Most people who retire or change jobs with company stock inside their 401k assume the right move is to roll everything into an IRA when they're done working there. And for many assets, that's true. But when it comes to company stock held in your plan, there's a special rule that can save you thousands of dollars in taxes if you know how to use it. It's called Net Unrealized Appreciation, or NUA. Done right, it converts what would be ordinary income into long-term capital gains, lowering your tax bill and giving you more flexibility in retirement. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump to the video. NUA stands for Net Unrealized Appreciation, which simply means the growth and value of your company stock while it's inside of your employer retirement plan. If you bought shares of your employer stock inside your 401k over time, the difference between the original purchase price, or the cost basis, and the current market value is the net unrealized appreciation. The tax code allows you, under specific circumstances, to move those shares out of your 401k and treat the appreciation portion as a long-term capital gain when you sell, no matter how long you've held the stock outside the plan. And that's powerful because long-term capital gains rates are either 0, 15, or 20%, depending on your income, and they're usually far lower than ordinary income tax rates, which can go as high as 37%. So what is the normal rollover route versus the NUA route? Well, here's what happens for most people. When they retire or leave an employer, they will roll over the 401k into an IRA. All distributions from that IRA, whether cash or stock, are then taxed as ordinary income when withdrawn. If you do this with company stock, you lose the NUA opportunity. All of that growth gets taxed at ordinary income tax rates instead of at favorable capital gains tax rates. With NUA strategy, you take a lump sum distribution of the entire 401k, transfer the company stock into a taxable brokerage account instead of rolling it into an IRA, and roll the rest of the assets into an IRA as usual. At that point, you're going to pay ordinary income tax immediately on the cost basis portion of the stock. The growth, or the NUA portion of that stock, that gets taxed at capital gains tax treatment when you eventually sell. And you can hold those shares forever theoretically and give your beneficiaries even more favorable capital gains tax treatment, which we'll cover later on. Let's go over an example to make this real. So imagine you have $500,000 total in your 401k and $200,000 of that is made up of company stock. The cost basis of your company stock is $50,000, which is what you originally paid for it. The current value of the stock is $200,000. That means the NUA portion is $150,000. If you roll everything into your IRA, every dollar withdrawn later is taxed at ordinary income tax rates. So that $150,000 worth of growth could be taxed at 24, 32, or even 37%. If you use the NUA strategy, you pay ordinary income tax now on the $50,000 cost basis. That $150,000 of appreciation is taxed at long-term capital gains tax rates when you sell. So if you're in the 22% income tax bracket today and the 15% capital gains tax bracket, this is what the math would look like. If you rolled over the entire $200,000 to your IRA, all of it would be taxed at 22%, and it would cost you $44,000 in taxes. So who qualifies for NUA? Not everyone can use the NUA strategy. You must meet all of these requirements. First, you have employer stock inside your qualified plan. Only company stock counts, not mutual funds, not ETFs. Second, you have to take a lump sum distribution of the entire plan balance. You can't just cherry pick the stock. You must empty the whole 401k in one calendar year. Third, there needs to be a triggering event. You must have a qualifying reason to take the distribution, usually separation from service or reaching age 59.5 or possibly even death. The fourth and final caveat is stock must go directly into a taxable account. If you roll it into an IRA first, the NUA treatment is lost forever. So what are some of the benefits of the NUA strategy? Well, first is lower taxes on growth. The biggest advantage is paying long-term capital gains tax rates instead of ordinary income tax rates on the appreciation of the company stock. Second is tax diversification. By splitting assets between a taxable account, holding the stock, and an IRA, you create more flexibility in managing withdrawals later on. Third is legacy planning. Heirs who inherit NUA stock step into the same tax treatment. The appreciation still gets capital gains treatment, and they also get a step up in basis on any post-distribution growth. Fourth and finally, charitable opportunities. Donating highly appreciated NUA shares to charity can wipe out the capital gains entirely, while you already paid ordinary income tax on just the basis. But that is not all. There's also some risks and drawbacks you need to be aware of. First is concentration risk. If a company stock is a big part of your portfolio, having so much outside of an IRA can expose you to risk in a single stock. Diversification may require selling quickly, triggering capital gains. There's also the upfront tax hit. You pay ordinary income tax immediately on the cost basis when the stock is distributed. If your cost basis is high relative to market value, the benefit may be very small. Or if the majority of your assets inside the plan are in that company stock and you have a seven-figure balance, you could pay big tax bills right out of the gate. Third, you want to be aware of the complex rules. If you miss a step, like rolling the stock into an IRA, the opportunity is then gone forever. Fourth, there's impact on Medicare and Social Security taxation. That lump sum basis amount could temporarily raise your income in the year of distribution, potentially triggering Medicare IRMA surcharges or Social Security taxation on that amount. So who should consider utilizing a net unrealized appreciation strategy? Well, first is long-tenured employees with company stock bought cheap, where the current value is many times higher than the basis. There's also those who are retiring soon who can trigger a lump sum distribution event. And anyone in a moderate tax bracket now who expects higher ordinary income tax rates later on due to required minimum distributions, pensions, or Social Security stacking on top. Also, charitably inclined investors who can donate the appreciated shares and avoid capital gains will benefit from this strategy. But there's also times when NUA does not make sense. If your company stock has a high basis, meaning there's little growth, there's little tax arbitrage to capture in that instance. If you plan to immediately sell and reinvest the diversified funds, the capital gains tax may offset the advantage. If you expect to stay in a low income tax bracket, rolling to an IRA and taking ordinary withdrawals might not be worse depending on how large your capital gains realization is in a given year and the other income sources you have in that year. Let's go over some planning tips for this year and beyond. The first thing you need to do is get your timing right. The distribution must be made in one tax year. Plan around your income to avoid bumping into higher tax brackets unnecessarily. Second, check your brackets. The long-term capital gains threshold in 2025 is $96,700 at the 0% level. Then at the 15% level, you have until $583,750 if you're married filing jointly. Line up your NUA sale with these brackets for maximum tax efficiency. Next, layer NUA with Roth conversions. If you're using retirement transitions to convert to Roth, consider the order carefully. Don't let conversions and NUA distributions collide in the same year without modeling in the tax hit. Fourth, keep in mind your state taxes. Some states don't conform perfectly to the federal NUA treatment. Review this with a local tax advisor who knows your state's rules. Fifth, document your tax basis. Your plan administrator should provide a breakdown of cost basis versus appreciation on a company stock. Double check it. Errors here could be costly. Finally, incorporate your NUA stock with tax loss harvesting. Another thing you could do is to move your appreciated stock into an account where you practice tax loss harvesting. As you realize losses elsewhere in your portfolio, you can then use those losses to offset gains on your stock with no tax implications, further saving you more in taxes along the way. Before we go into a quick case study, please be sure to hit that like button and subscribe to the channel. We really appreciate your support. And by liking a video, we know what kind of content our audience values most. This will help us to make the most of every video we publish just for you. Now let's jump back into the video with this quick case study. Linda's age 61, and she's retiring after 30 years of working hard. She has $800,000 in her 401k, including $300,000 of which is company stock, with a cost basis of $80,000. If she rolls that all into an IRA, all $800,000 will eventually be taxed at ordinary income rates as she withdraws. If she utilizes an NUA strategy, she pays ordinary income tax now on $80,000 basis of the stock. The $220,000 of appreciation will be taxed as long-term capital gains when she sells, and the remaining $500,000 of mutual funds she'll roll into an IRA as usual. By structuring it this way, Linda locks in a lower tax rate on $220,000 of net unrealized appreciation, she diversifies her tax bucket, and she creates options for charitable gifts or estate planning down the line. Let's wrap this up with some closing thoughts. The NUA strategy is one of the most underutilized tax breaks in the retirement planning toolkit. If you have company stock in your 401k, don't just assume a simple rollover is your best move. By handling the shares appropriately, you can convert what would have been ordinary income into capital gains, saving potentially tens of thousands of dollars in taxes. It's not for everyone, and it requires precise execution. But in the right circumstances, especially if you've built up company stock with a low basis, it can be one of the most powerful ways to stretch your retirement wealth. If you want to know whether NUA fits your retirement plan, that's exactly what we do here at NavWealth Partners. We analyze the numbers, coordinate with your tax team, and help you make a smart money decision. See you in the next video.